Hello, and welcome to this edition of Taking Stock for the week ending the 21st of March 2025. I'm Kien, Head of Research at Stock Doctor, and joining me today is our equities analyst, Charlie Song, to bring you all things share market. How are you, Charlie? And great to have you on board.
Yeah, good to be here, Ken.
Yeah, it's been a while since you've been here, so look forward to sharing insights with you this week. But before we begin, just a quick yet important reminder, the information we share today is of a generic nature and shouldn't be considered personal advice. Markets can be quite volatile, so any past performance figures isn't a guarantee of future performance. Well, Charlie, after weeks of turbulence, the Australian share market regained some ground this week despite ongoing US trade disputes. And investor sentiment, it seems to have improved as expectations for lower interest rates grew. And that's driven by slowing economic growth forecasts. And the US Fed, they held their rates steady, but did hint that potential rate cuts of up to 0.5% by the year end, citing transitory inflation from the tariffs. In Australia, though, we also had weaker job data, which raised hopes for an RBA rate cut in May as well, with money markets putting a probability of a rate cut at 78% from 66% last week.
Yeah, there's somewhat of a recovery in markets with China's economic stimulus plans boosting the resources sector
Mm.
early in the week. We also saw gold surge past 3,000 US dollars per ounce as investors seem to seek safe havens as geopolitical turmoil continues.
Yeah, gold's been on a stellar run, hasn't it, Charlie? But one stock that has countered this trend has been Ramelius Resources, which was removed from our coverage early in the week. And the company recently acquired Spartan Resources as well, aiming to fill the production gap from their Mount Magnet's underperformance there. But the deal does add scale, boosts gold resources by around 35%, and is also targeting to double their production capacity by around 2030. But Charlie, can you take members through some of our concerns here?
Yeah, on the surface, the acquisition does make sense. Dalgaranga is very close to Ramelius's existing Mount Magnet mine, which
Mm.
offers potential synergies, but the risks seem like they might outweigh the rewards. Spartan isn't as profitable because a large part of its value as an asset is yet to be developed, and the deal is highly dilutive, increasing shares on issue by 80%. This means that there's going to be immediate earnings dissipation, and management think that they could result in greater earnings accretion in future years. Additionally, Ramelius's capital expenditures will have to increase to develop Spartan's assets, which might add financial strain to our balance sheet metrics. These factors led us to remove Ramelius from our Star Growth stock coverage. For members who are still holding the stock, you'll need to consider whether you're comfortable with these risks or you think there are better gold opportunities elsewhere.
Yeah, with Spartan financially unhealthy as well, this acquisition is quite large and that could weigh on the balance sheet and profitability metrics of Ramelius. But I can also see under Golden Rule 3 that the negative earnings revisions have come through and the outlook beyond this year looks rather bleak as the business increases their capital expenditure to build out their production profile in the longer term. Now, shifting focus to another setback in the gold sector, Gold Road Resources. The company holds a 50% stake in the Gruyere mine. That's the one of Australia's major new gold operations. However, recent conveyor belt failures and also unexpected primary crusher maintenance have led to a production downgrade. Could this impact their earnings outlook?
The downgrade is a concern, Ken. Production did fall from 92,000 ounces in the fourth quarter to an expected 70,000 to 73,000 ounces, which is approximately 16% below what consensus were estimating.
Mm.
While FY25 guidance remains unchanged, the execution risks have increased, and we do anticipate downward earnings revisions in the coming weeks if they have not already come through.
Yeah, we're closely monitoring this one, Charlie, but this highlights the risk of relying on a single mine. Gold Road investors will need to factor this in, and it's a key reason why the stock does trade at a discount to industry peers as well. But moving on to Capricorn Metals, another gold player which operates two key Western Australian assets. The company recently removed its hedging strategy, and that's leaving it fully exposed to the gold price movement. How could this impact the business, and does it increase its vulnerability if gold prices drop?
Without a hedge, Capricorn will fully benefit from rising gold prices. But there is a cost. Instead of using cash, which has been reserved for the Karlawinda expansion and the Mount Gibson gold projects, they're raising capital by issuing shares, which is causing an immediate 4% dilution for existing shareholders. This strategy does hinge on gold prices continuing to strengthen.
Yeah, that dilution to equities doesn't sound too good, but investors didn't really react too negatively with shares down only about 4% on the day of the announcement. However, management's decision to use put options rather than the traditional forward contracts may partially help cushion downside risks if gold does weaken. So we'll keep an eye on that one as well. But looking ahead, plenty of REITs are expected to go ex-dividend next week, given that we're heading towards the end of the quarter. So refer to our corporate calendar for more information. In Under the Microscope this week, we decided to turn our attention away from gold and look into a sector you cover, Charlie, within retail as well. A stock that's quite interesting is fast fashion jewelry seller, Lovisa. This is a founder-driven business with Brett Blundy on the board, and he also holds a 39% stake in the business. And despite being a seller of cheap jewelry, the business does generate a very high return on equity and very strong profit margins. Why is this the case?
Well, it's due to a number of reasons, but it is mostly a combination of Lovisa's stores being very low footprint and them having a very well established and well run vertical supply chain, which allows them to really have some of the highest gross margins we see in that sort of business.
Yeah, and it allows them to control their costs quite well there. But the company did disappoint investors with a softer like-for-like sales in its first half 25 result, but its profit margins improved on the prior year, I noticed, and its trading update was better than expected, while store rollouts appear in line, Charlie. So why did the share price react so poorly?
Yeah, despite the positive or more positive trading update, really, its profits actually missed expectations by around 10%. And this was due to a combination of lower like-for-like sales and timing of tax losses, which drove a higher effective tax rate in the first half of financial year 25. We think that analysts have rebased their earnings expectations for the full year because of this downgrade.
Yeah, we saw earnings revisions come through negatively. So, from that perspective, we did transition the stock to borderline star growth stock status, Charlie.
Yeah, this was one of the reasons. The other one was the fact that the return on equity dropped more than our threshold of 10%.
Hmm.
We also note that the ROE decline was due to the growing equity base, which came mostly from higher retained earnings. The company's equity base tends to grow at the end of each interim period, so the end of every first half period, as the company earns a higher proportion of earnings in the first half and tends to pay a lesser proportion of dividends in the first half as well. This is more of an accounting mechanism than anything else.
Yeah, very interesting, Charlie. That probably explains why return on equity is expected to ramp up for the full year as well. But of course, there are other fundamental risks at play here, though.
Yeah, well, the store rollout appears to be gaining momentum again, as
Hmm.
what we can see from the trading update at least. But until sustained growth is sort of confirmed in the second half and beyond, particularly in the US, we think investors are being quite cautious. Further uncertainty stems from the CEO transition, which is slated for June of 2025, so very soon. But we think that without sort of any sort of confirmed successor, that may affect the momentum of store rollouts.
Yeah, there's definitely a bit of uncertainty there. And I noticed that there's a slower pace of expansion into China. And of course, ongoing cost inflation key concerns as well. However, with the stock trading at a slight discount to fair value, this may represent opportunity for some investors. The growth outlook does remain positive due to their continued expansion across their physical and digital store network. But those who are sensitive to declining share price trends should remain on the sidelines, given that it has triggered an exit on the SD30 TSR. So, with the high number of gold stocks available within our star stock universe, a question that's been raised by a few of our members this week is which gold stocks should you buy? Now, the benefit of having gold stocks in your portfolio is predominantly driven by diversification. Gold does act as an inflation hedge and tends to have low correlation to other stocks such as financials and technology. It also outperforms during periods of high geopolitical uncertainty, as we've seen over the last couple of months. However, on the flip side, gold stocks can be volatile because earnings are tied to the underlying commodity price. So it's also subject to the operational mining risks, as we've seen with some of our gold stocks recently.
Yeah, but before looking at gold stocks, the first thing you should do is ask yourself whether you are comfortable with the volatility associated with gold stocks and if it fits within your overall risk and return objective.
Yeah, then you need to decide how much gold exposure you'd be comfortable with. Is it 5%, 10%, or 15% of your total equity portfolio? But to avoid concentration risks, we do not recommend your total weight exceeds 20% in gold stocks.
After this, and to help you decide on what stocks you prefer, you can compare the gold stocks within Stock Doctor, either in the peer review table at the end of the 9 Golden Rules screen or via the watch lists.
Yeah, the watch list and the peer review table is quite useful there, but these will provide you with those standard fields. But if you do want to dig deeper, then you can create your own filter. Here you'll need to select only the gold GICS classification, then add fields like return on invested capital, projected revenue growth for the next 2 years. This is important. It's a proxy for production growth, price to consensus target as well, price to NTA, these valuation metrics, and also market capitalization.
If we sort by market cap, we can see the largest producers are Newmont, Northern Star, and Evolution Mining. These businesses should provide stable production over the next few years and should be less volatile than its smaller peers. Newmont is trading at the lowest price to NTA here due to its lower growth profile. Meanwhile, if you do want copper exposure, then Evolution Mining has 30% of its earnings exposed to copper.
Yeah, and outside of the larger players, among the more exciting emerging gold producers are Genesis Minerals and also Vault Minerals as well. Production is expected to ramp up strongly over the next 1 or 2 years for both these miners, which is translating to very strong revenue growth. Note that Genesis does trade at a premium to Vault because it does have quality management with a track record and also a longer mine life as well. There's also higher uncertainty around the outlook for Vault over the long term, given that it does have lower analyst coverage.
And amongst the emerging gold space, there is also Catalyst Metals, which we think has a really strong growth profile, but we note is really leveraged to the gold price, both on the upside and the downside. This is due to it trading on large premium to valuation grounds, but also being a higher cost mine. There are, of course, others like Perseus Mining, which trades at a discount due to its geographical exposure to West African mines, where there is some geopolitical risk. Gold Road also trades at a discount because even though it has tier 1 assets, it has had a pretty bad or poor recent track record in meeting market expectations.
Yeah, we're watching Gold Road very closely there. But on the other end of the spectrum, Capricorn Metals, it looks most expensive here because it does have proven track record as well. And lastly, you've got Ora Banda Mining, a smaller gold stock. It trades at a premium due to its strong management team. But again, it does have leverage to that gold price. But a key risk here is that it does lack the reserves to justify its current valuation. So something to be mindful of. But that's all we have time for today. Thanks, Charlie. Appreciate you joining us and sharing your insights across the gold and retail sectors.
My pleasure. If you have any questions, feel free to come to our Lincoln Live session on Monday.
Fantastic, Charlie. And hopefully you're managing your portfolio as well. And remember, stick to those high quality gold stocks and also maintain a well diversified portfolio because risk management is so important. For now, take care and have a happy, healthy, and prosperous week ahead.